Just about 17 minutes to the closing bell. Let's keep talking about some of the bank earnings, and to help us put them into perspective and what it means for our investments, we invite into the stream Brian Kleinhanzl. He is the managing director at KBW, a Stifel company. And Brian, it's good to have you here. I want to talk about Citi first. And in particular, we've talked about net interest margins at all the banks and what's happening there. But you pointed out in your note on Citi that they're exiting some of their consumer businesses in 13 different countries, and that's a good thing. Why?
Yeah, thanks. I mean, for Citigroup, one of the big concerns with the company has always been the complexity and how widespread their branch network is. It's not just a U.S. company, it's a global branch network that they manage to, and there's always been some concerns that global branch network leads to higher risks relative to the other U.S. banks. And so by exiting these countries in both Europe and the Middle East, as well as Asia, it's intended to reduce the complexity of the company. I think investors were looking for that, as well as these individual countries in the consumer business weren't really generating much profits for the company overall. So there really isn't much loss from an earnings perspective, and there's some reduced risk as well. So I think it's a positive for the company.
Brian, when you take a look at the stock reactions today, Bank of America in the red, Citi's in the red, a similar reaction to what we saw from JP Morgan yesterday after they posted better than expected results. What do you attribute this to?
Yeah, so the challenge for the U.S. banks, and it applies to Citi, Bank of America, JP Morgan, is that they really can't get away from the effects of both fiscal and monetary policy within the U.S., and those effects are readily apparent in the first quarter results for the U.S. banks. So you have the Federal Reserve kind of flooding the system with liquidity, which is increasing deposits at the banks, but also means interest rates are low. In addition, the fiscal policy that you're seeing, which is stimulus that's going to corporations, as well as stimulus that's going direct to consumers, is a positive. So what you've seen in the quarter is that spending's been up amongst consumers, and that generally means that there's less losses as well in the consumer portfolios for the banks. But it also means that there's not really a reason to borrow both from consumers and from commercial companies. And so loan growth has been weak, and that's what's kind of weighing on shares today, is the weaker loan growth relative to expectations. And there's still some concern as to when the U.S. banks will see better loan growth from here.
We don't think of Goldman Sachs as a traditional bank, and yet they've got Marcus. But in your note, you talked about them as a, quote, self-help stock, and you also anticipate that revenue growth is going to be muted. For Goldman, when they throw their weight around, someone gets a black eye and they come out on top. Why do you think growth will be muted?
Yeah, when you look from here, what you're coming into is generally the peak or getting closer to a peak of a cycle. So what we saw this quarter from a capital markets perspective is that really equity capital markets activity, so that's the issuance of IPOs and follow-on offerings by companies, has been just tremendously strong year over year. You're looking at something up 300% plus for Goldman relative to the prior year. So I think what you're seeing is this is a company that just posted $17 billion of revenues in the quarter. It's hard to duplicate that quarter after quarter. So as you look forward, there will be some positive elements still, but by and large, a lot of this impacts from the capital markets activity is expected to wane on a go-forward period. We do expect the economy to grow, but we do expect kind of activity to soften here on a go-forward basis.
Brian, we are going to get Morgan Stanley tomorrow. We've seen them restructure their business just a bit and really focus on their asset management business. How would you compare Morgan Stanley to the big banks that we've already seen report?
Yeah, so the unique, the immediate comparison is strictly with Goldman Sachs. They're still considered two of the premier investment banks globally. But what you're seeing is really a transition from Morgan Stanley more into wealth management, asset management, more stable revenue type businesses relative to where Goldman Sachs is. And I think investors have really appreciated that transition, and you've seen it both in the share price or stock price performance over the last year and a half, as well as kind of the valuations that these trade at. Goldman certainly trades at a little bit of a discounted valuation to Morgan. So I think that's what kind of investors are looking for, more stable businesses, because as you can see in Goldman Sachs' results, they can be volatile and very volatile quarter to quarter, but you have less volatility in Morgan Stanley's results. Both expected to be strong, but both looking at a little bit different avenues for growth from here.
Hey, Brian, is Morgan going to be able to dodge questions about Archegos tomorrow?
No, I mean, they will have to address that, but thus far, what it looks, I haven't said anything publicly on that, but we're not expecting losses. It looks like the U.S. banks were fairly good about risk management from that perspective. So they will have to address those questions, but we aren't expecting anything material from an actual loss perspective there.